Did you know that crowdfunding is growing at a rate of over 300% in the last 5 years, while venture capital funding hit a staggering $300 billion globally? These two funding methods are shaping the future of entrepreneurship. But which one could help you launch or scale your business? Let's explore that today. Welcome back to Funding Sparks. If you're an entrepreneur, you already know how important funding is. Today, we're diving into two game-changing options for raising capital: equity-based crowdfunding and venture capital funding. Both have their strengths, and both come with challenges. But how do you decide which is right for you? Stay tuned to find out. Starting or scaling a business is no small feat, and finding the right funding can feel like an impossible choice. On one hand, you have equity-based crowdfunding, where you raise smaller amounts of money from a lot of people online. It's democratic, exciting, and gives everyday people a chance to invest in your idea. On the other hand, you have venture capital funding, which brings in professional investors or firms willing to write much larger checks. They'll take a stake in your business, but they'll also bring their expertise, networks, and resources to help you grow fast. The real challenge is figuring out what your business truly needs. Are you looking to build a community of supporters and raise moderate funding? Or do you need serious cash and expert backing to go big? Each path has its pros and cons, and today we're going to break them down in detail to help you make the best choice for your business. Let's start with equity-based crowdfunding. This is when you raise money online by offering shares of your business to a large pool of individual investors. Popular platforms like Seedrs, Crowdcube, StartEngine, and Republic make it easy to showcase your idea to thousands, even millions of potential investors. How does it work? You create a campaign on a crowdfunding platform. You tell your story, outline your vision, and explain how much funding you need and what investors will get in return. Then, everyday people your audience can invest in your idea. Why choose crowdfunding? For starters, it's accessible. You don't need connections to wealthy investors or big firms to get started. It also helps you build a community. These aren't just investors, they are your supporters, your ambassadors, and often your future customers. Crowdfunding is also less intrusive. Unlike venture capitalists, crowdfunding investors usually don't demand a say in how you run your business. This means more freedom for you as a founder. But of course, there are drawbacks. Crowdfunding campaigns require a lot of work. You need to create compelling content, run ads, and continuously engage with your audience. And while it's great for raising moderate sums, think $10,000 to $500,000, it's not ideal if you're looking for millions. Now, let's shift gears to venture capital funding. This is the big leagues. Venture capitalists are professional investors who focus on startups with high growth potential. Think of big firms like Sequoia Capital or Andreessen Horowitz. They specialize in writing checks that can start at hundreds of thousands and go up to tens of millions. How does VC funding work? When you approach a venture capital firm, they'll evaluate your business for its growth potential, market size, and scalability. If they see promise, they'll invest money in exchange for equity, meaning they own a piece of your company. Why choose venture capital? VCs bring more than just money. They bring connections to industry leaders, potential customers, and future investors. They also offer mentorship, helping you refine your strategy and scale efficiently. Plus, having a well-known VC backing your startup can give you credibility in the market. But venture capital isn't for everyone. These investors often demand significant control over your business. They might want a seat on your board, and they'll expect rapid growth, which can sometimes push startups to expand faster than they're ready for. It's also highly competitive. Less than 1% of startups successfully secure VC funding. Here's where it all comes together: knowing your business's goals and priorities. Let me share 2 success stories that highlight how these funding methods can work. Take Green Tech Solutions. They had a great idea for an eco-friendly gadget, but they weren't looking to scale globally right away. Instead, they focused on building a community of like-minded supporters. They raised $250,000 on Crowdfung, used it to manufacture their first batch of products, and turned their investors into loyal customers. Now, compare that to Swift Logistics, a tech-driven logistics company aiming to disrupt the industry. They knew they needed millions to scale fast and compete with giants. They pitched to several VCs and eventually secured $5 million from Andreessen Horowitz. This funding helped them hire a top-notch team, expand their operations, and secure their position in the market. Both companies succeeded, but for entirely different reasons. Green Tech Solutions thrived by connecting directly with its audience, while Swift Logistics prioritized rapid growth with strategic backing. So, what does your business need? Let's sum it up. Equity-based crowdfunding is perfect for businesses looking for moderate funding and a strong connection with their audience. It's ideal if you have a consumer-facing product and value creative freedom. Venture capital funding, on the other hand, is the best choice for startups with high growth potential that need substantial investment and strategic guidance. But remember, it often comes with a loss of control and high expectations for rapid growth. The decision ultimately depends on your business's goals, funding needs, and growth plans. Now, it's your turn. Have you tried crowdfunding or worked with VCs? Share your experiences in the comments below. I'd love to hear your stories. And don't forget to check out our next video, Top Crowdfunding Tips for Beginners, packed with strategies to help you succeed. Don't miss it. And subscribe to Funding Sparks for more insights. See you next time.